I can't stress the importance of risk management enough if you have a goal of becoming a full-time, consistently profitable trader. Countless trading accounts have been blown for one and one reason only, and that is improper risk management. And if you don't take risk seriously, at some point in time, it will destroy your trading career. Improper understanding of what risk is a big roadblock to trading success. Now, risk management essentially is a problem for beginners. Market simply won't allow you to trade without taking your capital. Now, what exactly is risk? Risk is often portrayed as something negative, something that is dangerous. Let's say whenever you are taking a trade, you are never 100% sure what will happen in the market, no matter what anyone says. So if you bought, you are not sure that the market is definitely going to go up. You have to look at the other side of the equation, which is the reward that you may get for taking that risk. I'm really surprised when I see people talking about eliminating the risk from their trading. If you're not going to risk anything, there is absolutely no chance that you will be rewarded for it. We are always told to avoid risk, to avoid certainty, to only look for things which have a certain outcome and on and on. So how do we handle this risk in trading? Well, there is a simple formula to do it. My philosophy of risk is surmised in just one word, and that is ACME, ACME, and it stands for assess, control, manage, and exploit the risk. And that is exactly what I suggest you should do with the risk you are willing to take in your trading. See, risk is omnipresent. Risk is always there. For many traders, the risk is always there at the beginning of the trade. But I would venture out and say that risk is always present in the market. In fact, every moment, every price change in the market has a corresponding risk associated with it. Now, that risk might be big or small, likely or less likely, but it is always there. And that is exactly why so many traders keep struggling despite putting in a stop loss in their trades. Stop loss is not risk management. Many traders believe that not using a stop loss is sacrilegious. Every time they put on a trade, they will put in a stop loss. What happens? It works for a while, but then their stop losses start getting hit more often than not. They start wondering why their stop loss is getting hit. Why once their stop loss is hit, market actually turns in their favor. Stop loss is actually an inventory transfer mechanism for the smart money. They will hit your stop loss only to take the other side of that trade. So no matter where you put your stop loss, the smart money will always find a way to get to it. So let's look at an alternative way of risk management. Let us look at the ACME principle in a little bit more detail. Now, I did not come up with this ACME principle all at once. It was built painfully over a long period of time. And all the while I was making almost all the risk related mistakes that are to be made in the markets. So trust me when I say that all the learnings that I'm going to share with you have come from trial and error. They are not back tested, but they are battle tested. So let us get into it. The first step is to assess the risk. This simply means understanding the current balance of risk between a long and a short trade. Now, I'll give you a simple example. Let us say market is moving up and it is nearing a resistance. Now, there is always a good chance that that resistance will be respected. And if nothing else, there will at least be a short-term reversal from that resistance. So, if you are going into a resistance and you are holding a long trade or you are planning to take a long trade, the risk of taking that long trade, at least in the short term, is very, very high. And that tells you that you should not look for long trades at this moment in time. Alternatively, you should give markets more time to decide for themselves whether they want to break out or not. Once they give you confirmation, you can then proceed to take your long trade. Also remember, just because the risk of going long at a particular time is high does not automatically give you permission to short that market. Let us now look at the second step, and that is controlling the risk. Controlling the risk means finding those areas or zones in the market beyond which your trade idea is completely invalidated. Now, ideally, you should be putting your stop losses beyond such references or zones so that as and when that zone is reached, you get out of your trade voluntarily and you're not thrown out of your trade because your stop loss is getting hit. When you are in control of your decisions, when you are the one who is calling the shots, it does wonders for your confidence in trading. And that brings us to our third point, and that is managing the risk. Here you are looking to design strategies using various instruments of trade which will help you reap the benefit if your view on the risk plays out. Because of this futures and options segment, it is possible to design and devise strategies for all kinds of risk profiles on the spectrum. So, from as aggressive as selling naked options to as stupid as buying naked options, there is some possible strategy for everyone. Let us now look at the last part of the ACME principle, and that is exploiting the risk. This part refers to the fact that trading is a wealth transfer business and not a wealth creation business. You will only make money in this business if you are better than your competition. Now, there is a section in the market which is doing the right things most of the times, and they are aware of the behavioral inconsistencies of beginner traders. Now, the only way to achieve consistent profitability in markets is to be on the other side of the mistake that amateur traders make. Once you become good at spotting these amateur traders, trading will not only become profitable, but it will become incredibly fun too. Then we come to the last and probably the most important point in risk management, and that is capital adequacy. Now, I'm going to make a separate video on capital adequacy. If it is already out there, I will link it in the description and you will find it somewhere in the cards. And if it is not, it will soon be published. But if you are trading options, then you have to divide your capital in two parts. The first part will be used for putting on the trades, and the second part will be utilized to make adjustments to your existing trades or establish new ones to protect your capital if the market goes against you. If only you can control your grid and be patient in your trading, there is a very good chance that you will become a consistently profitable trader. And that is the only way to succeed in the long run. Now, I hope you like this slightly different take on the risk than what is usually suggested on the topic. Now, this is a vast topic and it has been covered in detail in my options course, which you can buy it as a part of my quarterly package. You can check the details on my website, aniruddhadeshpande.com, which is flashing on the screen. Thank you for watching this video till the end, and I'll see you in the next one.